China is the top refiner for 19 of the 20 minerals the International Energy Agency classifies as strategic across energy, defense, aerospace, and AI, with an average market share of approximately 70%. This is not a market position. It is a choke point. And in April 2025, Beijing activated it. The official narrative frames critical minerals as a supply chain challenge, to be solved through investment, partnerships, and new mines. The data moves in the opposite direction. The average market share of the top 3 refining nations rose from 82% in 2020 to 86% in 2024, while Western governments were already funding diversification programs. Concentration increased, not decreased. It did not happen by accident. Over 3 decades, Western manufacturers offshored mineral processing to China because it was cheaper, faster, and produced fewer regulatory conflicts at home. The energy transition has now transformed that industrial decision into a strategic vulnerability. Lithium demand rose nearly 30% in 2024 alone. The need for the materials that build batteries, magnets, and semiconductors is growing faster than any alternative supply chain can scale. The choke point is not in the mine, it is in the refinery. The top 3 mining nations' share of key energy minerals rose from 73% in 2020 to 77% in 2024. Concentrated, but not a monopoly. In refining, the picture is different. For copper, lithium, nickel, cobalt, graphite, and rare earth elements, the average share of the top 3 refining nations is 86%. China accounts for almost all of that growth, the single dominant supplier for cobalt, graphite, and rare earth elements. China has used this leverage before. In 2010, following a maritime dispute with Japan over the Senkaku Islands, Beijing cut rare earth export quotas. Japan's electronics and automotive industries scrambled. The world took note, briefly, then resumed purchasing from the cheapest available source. The lesson absorbed by markets was not that dependence was dangerous. It was that China would eventually resume supply. 15 years later, the calculus has changed. The Democratic Republic of Congo, which holds 71% of the world's proven cobalt reserves, sits at the second pressure point. Chinese companies control most of the DRC's industrial cobalt supply chain, including the Tenke Fungurume mine, operated by China Molybdenum, one of the world's largest copper-cobalt operations. The cobalt in your phone battery and electric vehicle motor routes through Chinese-controlled extraction, processing, and distribution. In parallel, M23 rebels seized Goma in January 2025 and Bukavu in February 2025, tightening their grip on key mineral trade routes in eastern DRC. On April 4, 2025, China introduced its first wave of export controls on 7 heavy rare earth elements, including dysprosium and terbium, along with related compounds, metals, and permanent magnets. The trigger was the Trump administration's Liberation Day tariffs. Exporters were required to obtain a license from China's Ministry of Commerce, a process regulators made deliberately slow. The results were immediate. Yttrium shipments to the United States fell to approximately 42% of pre-restriction volumes. Dysprosium to 41%. Terbium to 49%. In October 2025, Beijing went further. A second wave added 5 more rare earth elements and introduced extra-territorial provisions, requiring export licenses for products manufactured outside China using Chinese origin technology. The European Central Bank estimated that more than 80% of large European firms are within 3 intermediaries of a Chinese rare earth producer. The European Parliament noted that EU rare earth prices reached up to 6 times pre-restriction levels in the months following the controls. The DRC acted simultaneously. Cobalt prices had fallen from nearly $95,000 per ton in 2018 to $21,000 by early 2025, a collapse driven in part by Chinese oversupply strategy. Kinshasa halted all cobalt exports for 8 months. When exports resumed in October 2025, they came with quotas. 18,125 metric tons for the remainder of 2025, then 96,600 metric tons annually for 2026 and 2027. That is less than half of the DRC's 2024 output. Cobalt prices have risen from $21,000 to approximately $56,000 per ton as of June 2026. The DRC projects fiscal revenue of $2.3 billion under the quota system, compared to an estimated $617 million without intervention. On June 22, 2026, Beijing added a third targeted action against U.S. companies, extending an escalation pattern across April 2025, October 2025, and June 2026. The IEA projects a 30% copper supply deficit by 2035 and a 40% lithium deficit by the same year, even if all announced mining projects proceed on schedule. Copper ore grades have declined 40% since 1991. Only 14 new copper deposits were discovered in the past decade, compared to 225 in the previous 23 years. Average mine development timelines run 17 years. Western governments have responded with capital. Global investment in critical minerals reached $128 billion in 2025, a 62% increase from 2023 levels. The United States and Ukraine signed a joint reconstruction investment fund on April 30, 2025, covering 55 listed minerals, including titanium, lithium, and graphite. The Pentagon became the largest shareholder in MP Materials, the only fully integrated rare earth magnet producer in the United States. In May 2026, Australia ordered Chinese investors to divest from northern minerals. The processing gap, however, is structural. China added 400,000 tons of lithium hydroxide refining capacity in 2024 and 2025 alone, while Western facilities were still under construction. Lynas Rare Earths became the first company outside China to produce commercial quantities of dysprosium oxide in May 2025. At current scale, it remains a fraction of Chinese output. For ordinary people, this structure shapes the cost of the energy transition. The price of an EV battery, the affordability of a heat pump, the reliability of a power grid, all run through these mineral flows. If critical mineral refining remains concentrated in one block, which is the most likely outcome through 2030, transition timelines extend, costs rise, and the leverage that block holds over energy-importing nations grows. Billions in Western capital will not close the processing gap inside the decade. Beijing deployed export controls in April 2025, October 2025, and again in June 2026. The question worth asking is not what happens if this resource war starts. It started already.